Okay, Jubilee, Hunter, talking about stocks and bonds. A stock is the goods or merchandise kept on the premises of a business or warehouse, available for sale or distribution. A bond is a form of debt. Bonds, you serve as the bank, and you loan it to a company, a city, the government, that type of stuff. They pay it back in full, of course, with interest. Bonds generate steadier income. They're more safe than or less riskier than stocks. With all investments, you're paid more for buying a riskier security. Less creditworthy issuers will pay a higher yield or interest rate. Riskier issuers are called junk bonds. On the opposite side, with the best history, are called investment grade bonds. The safest issuer is the U.S. government, known as the Treasury, because they are virtually risk-free because they are backed by the full faith and credit of the United States government. Bonds with longer duration pay higher yield because your money is tied up in the bank for so long. Interest rates have the single largest impact on bond prices. As the interest rate goes up, the bond prices fall. When rates rise, new bonds are sold at higher rates, making existing bonds with lower rates less valuable. Jesus. If you hold on to the bond till maturity, no matter how many times the price fluctuates, your face value doesn't change because you bought it at a certain number of times, or at the time of purchase. You can sell bonds on the secondary market, but you won't get as much. And mutual funds, when you have more than one. Hey, are you stupid or something? Good job. Seriously, come on,
Okay.
now.
Oh, I'm sorry.
God damn. Jesus Christ. Mutual funds will fluctuate. There you go.
Treasury, T-bills, T-bills, T-bonds, savings, I-savings, agency, government, sponsored enterprises, insurance, no tax,
Municipal,
known
as munis. They're bonds for projects like bridges, all that stuff. Corporate bonds issued by companies. Par, which is known as face value. Duration, which is the bond's price sensitive to interest rate changes. And then there's stocks. There's two different types of stock.
Stock, command, and
yeah, common stock. You don't get dividends until everyone else is shared, and then preferred stocks, you do get money back. And stock is basically ownership in a company. Yeah. If you're given a certificate, you get money. Okay, done. Ended.